Hello everybody, welcome to this Let's Learn Futures webinar series brought to you by Bursa Malaysia Derivative and managed by LifeChamp. So this is Shane Chu, I'm the moderator for today's session. So we are very excited to have you online today with us. Today we are going to talk about 6 steps to kickstart your futures trading. And for those of you who are new to futures trading, this is a session where you're going to increase your knowledge about how you can get started in doing futures trading. All right, so before we begin, just want to do the disclaimer first. As usual, whatever we share on this webinar is only for educational purpose. In no way that I give any buy or sell signal to any futures trading contracts that we mentioned. So if you decide to long or short any position in the trading contract, you do it at your own risk. Okay. Now this is the remaining BMD webinar for this year. We have 3 more upcoming in December. So today is the last webinar for the month of November. So next month we have 3 more in store for you, which is we talk about the mind game for trading success, pengurusan modal dan risiko dalam pasaran niaga hadapan, and lastly we talk about Fibonacci 期货交易策略. So one in English, one in Malay, and one in Mandarin. So if you want to attend the next few sessions, please reserve your Thursday for us, where we're going to delve deeper into different aspects of trading, in futures trading. Now, allow me to introduce the speaker today, and she is none other than Fiona Tang. Okay, we rarely have a female speaker, and today we have Fiona joining online with us to talk about the 6 steps to kickstart futures trading. Now, Fiona Tam holds an honors degree in chemical engineering from University of Malaysia, Pahang. After graduation, she worked as a project engineer for 1 year before joining an investment bank in 2012. So from reading many books and articles, Fiona has great interest in equity and derivatives market, which led her into the industry as a trainee dealer. So after 1 year in the profession, Fiona was promoted to senior executive and became a dual licensed dealer representative in mid-2013. So that year, the headquarters of investment bank awarded her with the best rookie of the year in Selangor State. So on separate performance, she was selected as one of the top 50 performers nationwide that qualified for the investment bank's dealer convention 2014 in Bali. So in August 2014, Fiona converted to a licensed remiser and became independent in her business. In 2018, she was once again selected as one of the top 80 performers nationwide. So she is now the founder of Brain Plus Sdn Bhd, which will promote finance and wealth management knowledge. So without further ado, let me hand over the session to you. Fiona, are you ready?
Okay.
All right, excellent. You can now share your screen.
Can see my screen now?
Yes, can see. Yeah, you can go full screen.
Okay.
Perfect.
So hi, good evening. Fiona here. So 6 steps to kickstart your futures trading. So this sharing session actually for those who want to explore alternative trading besides stocks trading. So and then totally new to futures trading. So I'm here to introduce you this product. I'm not going to talk about technical analysis and all that. Purely on futures, what is futures, and then how to start, and then what we should take note before we start trading. Okay, so let's have an overview of the 6 steps. So step 1, of course, concept. We have to get the concept of what is futures, and then what is futures contract, how we trade, and how to open an account, and then how it operates. So step 2 will be understanding of the products, because we know that futures actually comprise of a lot of different products, from oils to gold to maybe index interest rate. So and then step 3, we will talk about if let's say you want to start trading, where you should open your trading account, and then how to open, what document needed. So step 4 would be fund your account, because you need to fund your account to start trading. And then step 5 would be trading plans. We will briefly talk about the steps to build your trading plans. And then step 6 would be start trading. Okay, so let's start. For the first one, concept, what is futures? So usually when you search for the, when you search Google, you actually get something like this, an agreement to buy or sell standardized contracts of commodity at some points in the future with its price determined by today. So actually quite confusing. So I actually put into a picture and let you know. So futures is actually a contract. So you see this is a contract, futures, for you to buy or sell the underlying products. It can be commodities or interest rate or stocks. So here I put example, palm oil and also gold. So for you to buy or sell a standardized contract of underlying assets at a specific price at a specific date means you buy now at a specific price determined today and deliver in the future date. So we call future. So let's we explore more example. Let's say Mary. So she make candies. So she sell candies for RM10 per pack, and her ingredients sugar. So she get the sugar at 5 ringgit per 100 gram. So for this 100 gram, she make the sugars, the candies, and then her profits actually for this, at this price of sugar, 10 ringgit minus 5 ringgit, she actually make 5 ringgit profit. So imagine that if let's say sugar price increase to 7, so profit will drop to 3 ringgit. And if sugar price drop, then Mary will make more profit from it, right? So as a proactive businesswoman of her, so she want to focus on how to make good candies and then how to market her candies. So she do not want to worry about the price of sugar, the commodity price. So she looked for the sugar seller, and then this is Mr. B. So she talked to him that she want to buy from him for sugar for the next 1 year at a fixed price at 5 ringgit per 100 gram. So seller say think that it's a good deal. So he locked in this contract with candies maker, means Mary, so that he will supply in future every month for her the sugar at this price, 5 ringgit per 100 gram to her. So in this scenario, Mary lock in the price and she do not need to worry on the fluctuations or volatility of the sugar price, and she can focus to make candies. So like for the seller, then he actually, because he locked in the deal already, so he no need to worry for the next 1 year how he could sell the sugars. And this situation is actually like futures contract, that we buy or sell something under underlying assets, like this case, as a sugar, at a fixed price, predetermined price, and deliver in a specific date. Okay, so I hope you get me until now. So in this case, for Mary, the one who buy the contract, we say she long the contract. So for the seller, Mr. B, that sold the sugar to Mary, we call, he actually sell the contract. So we call as a short. So he short the contract to Mary. Okay, so this is essentially how the futures market work. So contracts actually originated as a way for companies or producer, manufacturer, that for them to actually hedge their costs. But these days, for futures trading, futures contracts are widely used by speculators or traders looking to gain exposure to the price fluctuation of the underlying assets. So underlying asset, just like what I mentioned just now, can be anything from commodities, individual stock, or interest rate. So we go for next. Okay, this is a very simple example of long a contract. If let's say you are the one who long the contract, buy the contract, you are hoping that price go up, so you profit from the price appreciation. So like for example, here you buy at 130.55 price, then you're hoping the price will go up. So then you will make profit by selling the contract. So this is a very important concept. To close a position, we always do the opposite direction. So if let's say just now I said that we long a contract, so to close the position, you need to do the opposite side. So means to close a position, you need to sell the contract from the market. So means offset the position. So like for this one is to, if let's say you shorting a contract, means you are profiting from the reducing price. So if let's say you sell at 132, you actually hoping the price to go down, then you profit from the reducing price. So like for short a contract to close a position, you have to do the opposite side. So meaning you have to long one contract from the market to offset your position. So the concept very simple. If you long one contract, price go up, you short one contract to close it. So if let's say you short one contract, do the opposite, you long back one contract to close the position. So this is you have to bear in mind because a lot usually we used to the stock trading, we buy a stock at 2 ringgit, then price went up to 3, then we sell it. So we know how to buy and then sell, but we actually no idea on sell a stock and then buy back a stock at lower price that we profit from the lower price. So in futures we can do two way. We can long a contract and also short a contract. So next one, this is put one example of the palm oil futures chart, the price chart. So as you can see, this is the daily chart for the past 1 year. So this is a perfect downtrend example, and this one is the perfect uptrend example of the price from here going down and then from here going up. So actually roughly just want to let you see the price movement of the commodity. So how to trade and then where to enter and exit, that one have to depends on your depends on whether you want to use technical analysis to do it or you want to be a fundamentalist and then to based on the cycle of the production of palm oil and then you do a long or hold a short position. Crude oil price, okay. And then we talk about contract size. Very common when we communicate with our broker. Let's say you do a position and then you ask your broker that whether you make money or you are actually losing. He will say, oh, the price move up 2 ticks from your price, or the price move up 2 tick, move down 2 ticks from your price. So actually the tick size, is the tick size. A lot of people were confused. So here I'm going to explain to you how this come out. So like just now I mentioned for futures contract, okay, we buy or sell a underlying or standardized contracts, right? So for let's say for example palm oils, for one futures contract actually you're holding 25 metric tons of crude palm oil. The other example would be gold. When you hold one contract of gold futures, you're actually holding 100 grams of gold. So okay, clear? And then from the price quoted, okay, on the futures exchange or your platforms, the price that you're seeing here, bid ask last done 3273, 3273. Actually, all these prices are quoted per unit. So this is example of palm oil futures. The 3-4, let's say for example, this one for crude oil we look at February 2021. The last time price is 3273. Actually is 3,273 ringgit per metric ton. So whatever you see, actually the price quoted are per metric ton. And then remember just now we said that for one futures contract, you actually holding 25 metric tons, right? So we give a example. Let's say you long one futures contract at FCPO at 3,000 per metric ton, at 3,000 level. So the price increased to 3,001, means you're actually making $1, right? So $1, 1 ringgit per metric ton. So, and then your contract actually holding 25 metric ton. So your total profit, you have to use your 1 ringgit times 25 metric ton. Then you get how much you earn for 1 ringgit movement. So this, in this case, is 25 ringgit. Usually we wouldn't say, oh, your price up 2 ringgit from your entry position, or lost 2 ringgit for your entry position. Usually we use tick size. And this is because also for palm oil, the minimum price fluctuation is 1 ringgit. Okay, we look at the codes. You see here. So for the bid and ask, people put in the price. The difference is only 1 ringgit. Means when we park order, we park 3,000. The next one will be 3,001, 3,002. So this means by minimum price fluctuation is 1 ringgit. We also call it tick size. Okay, so go back to the example just now. 3,000 and then move up by 1 ringgit means move up by 1 tick and equal to 25 ringgit. Why 25 ringgit? Because the contract you are holding actually 25 metric ton. So this is how we calculate the tick size, the tick value, the tick size value. Another example, we talk about like futures, gold futures. So for gold futures, one contract actually is about 100 grams per contract. So the price that we see from the quotes, you see here, actually gold future, not much volume. Okay, so do you see 244? And then the settlement price 252.75, 258.50. So this is the price quoted per gram, RM 244 per gram, 252.25 per gram. So, and then you're holding one contract means you're holding 100 grams of gold. So when, let's say we take example, you short one futures, gold futures contract. So you're profiting from price dropping, right? So let's say you get at 230 per gram. And then the price moved down to 230.05. Why 0.5? Because for FGLD, the minimum price fluctuation is 0.05. So meaning tick size is 0.05. So move down to actually move up to 230.05, meaning 0.05 against you. So how to calculate what's the value? Okay, you use the 0.05, you times the contract size of the FGLD, which is 100 grams, then you will get 5 ringgit. So conclusion, meaning that for 0.05 move is equal to 5 ringgit. So from there, you actually can calculate if, let's say, price movement for one ticks is 0.05 and equal to 5 ringgit. I hope you get this. But after later on, actually, we will study the contracts. So under the contracts, they actually spell out the tick size and then the minimum fluctuation price, the volume value, how to calculate. So later we'll go further into that. Okay, so go back to still the concept, similarly to the buying and selling shares. So when futures market price go up, if let's say you are the long side, then your position will make money from the appreciation of the price. However, in future, if let's say market price go down and you are at the short side, means you're selling, then you're making profit from the price dropping. The calculation, how to calculate your profit is, if let's say you long and when market prices go up, profit equal to exceeding price minus entering price times multiplier of the futures contract times number of contracts. Okay, it's like that. So if let's say you long a futures position at this price, so enter your enter price and then price go up. Let's say you go in at 1 ringgit and then price went up to 3. So you use 3 minus 1. So you have the difference of the price, right? Then you times the multiplier of the futures contracts, mean the tick size value, just now we talked about it. So I take this one, take the FCPO as example. So the one ticks equal to 25 ringgit. Just now we learned that. So you use 3 times 25 is the profit that you make, and then times how many contract you are holding. So if let's say you're holding one contract, you will times 1. So this example is that if let's say if let's say you long at 2003 and then you exit at 2005, so you minus and then you get the difference, price difference, and then you times 25 times one contract, so you're making 5,000 ringgit. So we talk about if let's say market go down, entering price minus exit price times multiplier of the futures contract, the contract value size, the tick value times number of contracts. So you short at, let's say, 2005, and then price indeed go down. So price go down to 2003. So the difference is 200 times 25, the tick size value, times one contract. So you are actually making 5,000. So the same thing, if let's say you shorting a contract at 2,500, but the price went up actually against you, the same formula also apply, but it's negative. Okay, we have to be clear that we long, then price go up means profit. If we short, price go down means profit. If opposite direction means you are losing. Okay, and futures vs stock. Why we go for futures trading? Here are some sharing. For short selling, we know that last time, but now stock market, actually we can short selling the stock. So long time ago, we only can buy stock, means we only can profit from the price appreciation. If let's say stock go down, stock price go down, we actually cannot do anything unless we hedge it into FKLI futures. So like for futures, we can long and so we can short, very easy to do, not very tough. And for stock, it's regulated, of course, and then very tedious because we need to sign a form to get approval and then to sign the agreement to understand that if let's say we do intraday short selling, today we short, today we must buy back. If let's say we didn't or forget to buy back, so we have certain penalties. So it's very to us like very tedious and many charges. So like for futures, very straightforward, buy and sell. But of course, for futures contract, there are some maturity dates, means expire date. So means within a month you have to close your position, and then depends the futures contract you are trading. Some actually you need to deliver the underlying assets, or some are actually cash settle, means we settle in cash. One is because of the short selling, the easiness of short selling. The second is hedging. So an investor with stock portfolio can use futures to hedge against the dropping market. So meaning that if let's say you hold a portfolio of stocks and the price actually reducing, dropping, and you making some losses, but you do not want to sell your stock, actually you can hedge your position by shorting the KLCI futures, which we call FKLI. So the portfolio actually reducing in value, but the short position in FKLI actually making you money. You are actually not really making money, but the profit that you're making is like offsetting the losses that you're making from your portfolio, the stock portfolio. So we call hedging. So like if let's say you do stock only, then you only can sell. So means you will realize your losses, or you can choose to hold. So next one will be the transaction cost. Okay, for futures are very easy and very straightforward. You will actually charge, you actually get charged by, you have Bursa levy and also the brokerage commission to broker, so brokerage plus the 6% SST. So means when you go in one position, you will charge one time, charge one time, and then when you close your position, you will get the same charges. So very straightforward. So like for stocks, Okay, I'm not saying the stock not good, just that I'm telling you the structure of stock trading, the brokerage structure. So like for stock trading, of course, brokerage, they have a different value. Let's say, for example, less than 100K, and reminder key in would be 0.6%. More than 100K would be 0.3%. And then stamp duty 0.1%. And clearing fee, Bursa clearing fee 0.03%. So you actually have a few different charges, depends on, let's say, different amount and different charges. So you have a not very simple structure of the brokerage charging. So this is one of the reasons why people will actually go for futures. And then the ease of monitoring. So okay, for futures, because of the expiry date, so we have to we have to be clear on the product, the contract month that we're trading expire on which day. So and then the contracts, whether it's physical delivery or cash settle. So very simple. And for stocks, like here, investor has to be concerned over the custody, over keep track on, because stock always got right issue lah, split lah, bonus issue lah, dividends are price movement change out. Then if let's say got right issue, you subscribe already, then price change, and then for every rights you subscribe, they give you 4 warrant. How to calculate? Not very easy lah. So for futures, it's like very straightforward. You will not buy one FCPO contract then get one bonus CPO contract one. Okay. And of course, for futures trading, we need to put in money to start a trading. So for every different products, we have a margin set by Bursa derivative. Okay, we call it margin, the margin deposit, initial margin. So here for futures, I actually margin as at 16 November. So for you, in order for you to go in one lot, one contract of FKLI, you have to put minimum 4,200 as a margin deposit inside for you to go in one lot. So for palm oil futures, FCPO would be 4,500. And for FGLD, gold futures would be 1,000. So you at least need to have this money ready for you to go in one contract. Of course, this margin will change based on the volatility of the market, and Bursa derivative actually will inform, and your broker will inform also. How does margin call works? So like just now I mentioned, for the contract, you have to minimum put in, let's say for FKLI, you have to minimum put in 4,200. So to go in one contract. If let's say you long FKLI at 1,500, this level, and price drop to 1,450, you're actually missing the 50 ticks, right? So the 50 ticks, later we will calculate I will guide you how to calculate the value. Then this losing amount, actually, if let's say you didn't close the position on the same day, this losing amount carry forward the next day, your broker will call you to ask you to top up the margin. And then this short of margin, we will call it as margin call. Because as what we say just now, I said just now, for minimum one contract to go in is 4,200. So you have to always have this amount in your account for you to hold one contract overnight. Okay. How does margin call works? We take one example. Your account have 4,200, just enough for one contract of FKLI. So on day one, futures contract last time price is 1,850, and then you go in and buy one futures contract in spot month. Spot month means current month. So current month November, so you go in futures contract and buy November contract at 1,850. So at this price. So end of day one, futures market settle as 1,838. So actually mean the price is actually lower than the price you enter, right? So what we say just now, you long market, then you will hope that market go up, then you profit from the price appreciation. So this case, 1,838, meaning that you are losing. So we calculate the losing ticks. So you use the 1850 minus 1838, so you're actually losing 12 points. And in FKLI, one ticks, one point move is equal to RM50. Actually, for FKLI, movement is 0.5. 0.5 equal to 25 ringgit. So in this case, for 1.0 movement, it will be equal to 50 ringgit. So 12 ticks, you times RM 50 ringgit times one contract, you're actually losing 600 ringgit. So let's say you didn't close the position, you hold it overnight. So balance in the account would become 4,002 minus 600. So now your account from 4,002 are now become 3,006. So what we say just now, for FKLI for one contract, you need to at least have 4,200 inside for you to hold one contract. So in this case, your account becomes 3,600 already. So next day, you will have the day one margin call. Okay, day one margin call 600. So your broker will tell you, hey, you have margin call of 600, you have to top up, or you sell your contract, means you close your contract lah. So day two, continue. Day two start with margin call of 600, and then market drop further. You're very unlucky, market drop further to another 30 points, mean crash 30 points to 1808. So how much your losses? So yesterday's settlement price is 1838. Yesterday settled as 1838. So you minus 1808, you get 30 points losses. So another 30 points. Then you calculate the value times 50 and then times one contract. You are losing 1,500 more for day two. So your balance in account become now 3,006 minus 1,005 and become 2,001. So you have to decide whether you want to hold your contract or you top up the shortfall of the margin, because you need to have 4,200. Next one. So I give you two scenarios. On day three, if let's say the day before, mean day two, you already top up the 600, the first day margin call. So you continue to hold the position and you have a margin call of 1,005 on day three. So day three, you start with margin call of 1,005. Scenario two, if your 600, you do not want to top up by 4 p.m. usually, and actually broker will ask client to liquidate the position, means to close the position. And day three, you will not have any margin call. It depends, means for every margin call, day one margin call, day two, you have to settle to continue to hold. If let's say you do not want to settle, then you just close the whole position. Because we always need to have the initial margin at our account for us to continue to hold one contract. So for this account, if let's say you want to go in for FKLI again, then you need to at least top up to 4,200 to continue. So margin call, I hope that I explained clearly. And then the other one is the leverage concept of futures. It's a product that we actually pay a certain percentage of the full underlying asset we're holding in order for us to go in one contract. So we call leverage, means if let's say I want to buy this product at 10 ringgit, but I do not need to pay 10 ringgit to go in. I only pay 1 ringgit first until I sell the product. So this is called leverage. So the concept of leverage actually is very powerful because it allows us to efficiently use the capital. Also, in another way, we call boost returns. So also enable you to control a larger size of investment with a smaller capital outlay. We look at example. Okay, like for FCPO, we look at FCPO. Notional means like this one I use the price. Okay, we take one example. So let's say for example, CPO now trading at 3,000 per ton. And then we know that for one FCPO contract, it actually contains 25 metric tons of crude palm oil, right? So you use 3,000 per ton, per metric ton, you times 25. Actually, the full contract size is valued at 75,000. So when you're paying, so for the FCPO margin, you remember, just now is 4,005, meaning for you to hold one futures contract of the palm oil contract, you actually need to only pay 4,500, and the whole contract actually worth 75,000 in value. So meaning you use a small outlay to hold a larger size of the underlying assets. This we call leverage. So like for, this is the simple table I made. For like FKLI notional is about 80,000. Margin is required is 4,200. So capital outlay about 5.25%. So the leverage actually is 19 times. Like for crude palm oil, notional is 82,025. Margins only 4,005. So capital outlay 5.49% and leverage is 18 times. Same for gold, capital outlay 3.85% and the leverage is 26 times. So it's actually very high for leverage. So this is actually to want to deliver that if let's say we want to trade futures, we do not need to fork out the whole amount of what the underlying worth to actually for you to go in one contract. Like for stocks, if let's say you want to buy 1,000 of shares of maybe 2 ringgit worth, you have to fork out 2,000 ringgit for you to hold the stocks. So like for futures, you only fork out the initial margin for you to hold one contract. So just want to deliver the concept between of stocks and futures you actually leverage. You have this leverage too. Friend or foe. So for leverage, if enables an investor to control a large amount of asset with small capital outlay, yes. So the cons will be investor will easily overtrade because you're using lesser amount to hold the contract. So for 100,000 of your capital, you actually can hold a lot of contracts rather than just one full paid FCPO contract. Just now we say about 75,000. So you actually use 4,500. So for 100K you actually can hold more than one contract of crude palm contract. So you easily get over traded. Greatly enhance returns on capitals. Of course, greatly the opposite also true. Greatly multiply the losses as well. So the higher the leverage, the more efficient. Losses could go beyond initial capital. And professional know how to advantage on using this tool. Like for the new trader or amateur trader, if let's say you didn't do well in your risk management or money management, then you will have problem of over trading, then over loss. So that might not be good. This have to bear in mind. So when we do futures, we actually advise clients not to just put the enough amount for one contract. Usually, if let's say you want to trade one lot of FCPO, we will advise client to put in 2 times the initial margin needed. Let's say 4,005. So we need to put in about 13,500, maybe 14,000 inside for you to go in for one contract, so that when you have slightly losses of 1 or 2 ticks, it won't bother you to keep on top up for margin call. So you have the buffer. So also you have a nicer experience when you do trading. So step 1 is about concept. So I cover the concept. Okay, so it's futures we can long and short, and then how to calculate the profit, the tick size, the value size. Now we go for the next one, step 2, understanding the products. Okay, so I want to show you the Bursa Derivative website. Okay, you go to Bursa Derivative and then you type Bursa Derivative, right? Google, you will get this one. You click in the website. And then you scroll down. Okay, you see these three products: commodity derivative, equity derivative, and also financial derivative. So actually you can click in to read more. We look for the commodity first. So inside the commodity, you will see all the futures contract available listed here. So this is gold futures, crude palm oil futures. So now we talk about crude palm oil futures, and we have many others. But today I'll focus on FGLD and also FCPO. The other one will be FKLI only. So the rest you can click in to explore. But as starter, you actually can go for FCPO first. Okay. So you click in the FCPO contract. Actually, it will show you the underlying instrument is crude palm oil, and then contract size how much, and then minimum price fluctuations how much. So all the information you actually can get from the Bursa Derivative website. Then we go back. Commodity, like palm oil, gold, and then like we go for derivative menu. Also we have equity derivative. Equity derivative like FKLI, very common one. And all this single stock futures means you actually can long or short particular stocks. And then we also have financial derivative. So all you actually can check from the Bursa website, Bursa Derivative website. So now we go back to the slide and look at the products. Okay, so I list out the things that we need to take note before we actually choose a product to trade. So for this one, things to take note: underlying instrument. Of course, you need to know what you are trading, and then the contract size. So for one contract you're holding, actually, what's the contract size you're holding? Means 100 grams of gold or 25 metric tons of palm oil. You have to understand. You have to know that one. And then the minimum price fluctuations means minimum tick size we call. And then the contract months means which month we can trade for. Like how many months we can trade. And then trading hours, of course. Final trading day and maturity date. This is very important. The expire date of each contract. Of course, the seven will be the settlement. Settlement means only two, either physical delivery or cash. Physical delivery means if, let's say, upon expired, you didn't close your position, you either need to deliver the underlying asset or you have to receive the underlying asset. Okay, we take first FCPO as an example. Underlying crude palm oil, contract size 25 metric tons. Minimum price fluctuation means they move by 1 ringgit per metric ton. So tick size is equal to 1. And then contract months, spot month, current month, and the next 11 succeeding months, and thereafter alternate months up to 36 months ahead. We look at example. So spot, next 11 succeeding, and then after that alternate months up to 36. Let you see the codes. Okay, we go to the website, FCPO. I hope you can see my screen. So the spot month, which is December, and then the succeeding 11 month, Jan, Feb, March. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. And then alternate month up to 36 months. So 11 months succeeding, no, then December, alternate month, right? So November, Jan. So Jan, March, May, June, 36 months. So up to next year, November 2023. Here are all the contracts available for you to trade. But of course, as a trader, we go for the highest traded one, means where the volume lies. Because if let's say we go to this very far one, no size for you no codes. So if let's say you have contracts maybe you long and short one contract, you're not able to get out when you need to get out. So usually we trade the third month. The most volume for the FCPO particular, you have to remember, is the third month. Always we call active month. The third month is where the volume lies, mean the highest volume. So which is February for FCPO now, the February month. So for FCPO, we have to remember, always trade the third month. Second month, okay, but very close to the spot month. So usually we not encourage, but usually we trade on the third month, the most active one. Then we go back to the slide. Okay, so this is what it means by spot month, next 11 succeeding months, thereafter alternate out month up to 36 months ahead. So trading hour, Monday to Friday. So 10:30 start, very good time. You actually wake up at 9, you still can have your breakfast. So rest a while, then start. 10:30 until 12:30, and then lunch hour. Then 2:30 p.m. until 6 p.m. of the day. So trading hour, and then business day follow KL business day. So follow KL business day. So if I just Selangor cuti, FCPO open or not? Yes, so long KL business day, then FCPO trading. Final trading day and maturity date. Contract expired at noon on the 15th day of the delivery month. Delivery month means the spot month. Or if the 15th is non-market day, the preceding business day. Okay, so I make it simple. For palm oil, futures palm oil, every 15th of the month is the expiry date. So if let's say just now we're trading February, right? February contract months. Sorry, no. We go back to the goods first. Futures. Okay, delivery month is December, Jan Feb. So December, now it's 24. So means 15th of December, December month means the delivery month, the spot month will expire. So we're totally out from the board. You cannot see the codes. This this very simple. So meaning for February on 15 December, February also from third month, it will become second month because December take out already, because December expired already. So January will become the spot month, and then February will become the second month. Then March will become the third month, also we call active month. So you have to remember, if let's say you have position in palm oil futures, every 15th of the month will be the expiry date. So like now, if let's say you go to February and long one lot, you have to get out before next month, 15th of December, because February will become second month by next month, 15th of December, when December expired and no longer quoted at the board. So January will move up, become the spot. February will become second month. March will become third month. So I hope you get me. So for FCPO, and then of course settlement. So for FCPO deliverable, meaning is physical delivery. So FCPO, let's say you, for example, you traded spot month, you long one contract and you forgot to close position. Somehow your broker also forgot to tell you to close position, and you're holding one lot and expired, meaning you have to deliver 25 metric tons of palm oil to the buyer, to the seller. Sorry, you are buyer. Okay, you're buyer, meaning that someone will deliver 25 metric tons to you. If let's say you are the seller, you short the position, you didn't close position, and after expired, you have to prepare to deliver 25 metric ton of crude palm oil to the buyer. So this is meant by physical delivery. But usually we will, as broker, we actually will remind clients to close position if somehow client hold position and forgot to close the contract. FCPO. This is the example of the FCPO chart, daily chart over the 5 years. So you can see very trending. but of course volatile at times. And then so we look for the next one, FKLI. This one is related to the KLCI index. They're tracking the top 30 of the stocks of KLCI, our Bursa Malaysia. So underlying, very clear, FTSE Bursa Malaysia Kuala Lumpur, so KLCI, the KLCI index, they're tracking that one. So contract size, you use the KLCI index multiplied by RM50, and minimum price fluctuation is 0.5. So meaning for 0.5 ticks movement, you multiply by 50 ringgit. The contract size is 50, RM50. So meaning for 0.5 movement actually equal to RM50, RM25 ringgit movement. Means if let's say you long FKLI is at 1,500, move up by one ticks is 1,501, you make one tick, right? Or one ringgit. So actually 0.5 times 2. So means 50 ringgit. And we look for the contract months, spot month, the next month, and the next 2 calendar quarterly month. So I show you the website. Go to RHB, go to the futures board for FKLI. Okay, spot month means November, and the next month, December, and then quarterly month. So the next quarterly will be Jan, and then March, and then June. So this is the available contract for you to trade for KLCI futures. We go back to the slide. Trading hour. First trading hour. FKLI earlier started at 4:45 a.m. until 12:45 p.m. and then take a break. 2:30 p.m. start until 5:15 p.m. Actually longer time than our usual stock trading hours. So final trading day, the last business day of the contract months. So this one very straightforward, not a certain number of the month. Like for November month, when expired will be the last trading day, business day of November, expired. And December will be the last trading day of December, then expired. So you do have to remember it's 15 or 20 of the month. Okay, for FKLI, very straightforward. And final settlement, cash settle. So you do not need to worry if let's say you forgot to close your November contract. It will be actually cash settle, means you only either you make profit or you make losses, settle in cash. Okay. This is FKLI chart, daily chart for the past 5 years. So actually hanging around at this one, about slightly below 1,600. Whether it will break through or not, then we will see. Okay. Next, we talk about gold futures. So gold futures, this one actually in Malaysia ringgit one, for Malaysia one, underlying asset is gold. And settlement method, okay, this one is cash, it's not because usually commodity physical delivery, but for this one is cash settle. So contract size is 100 gram, price quotation ringgit per gram, minimum fluctuation is 0.05. So meaning one tick is 0.05. When we quote the price for gold, let's say 200, the next one will be 200.05, and then 200.1, 200.15. For 0.05 movement actually equal to 5 ringgit. Trading hour Monday to Friday, trading session Malaysia time 9 a.m. until 12:30, and then 2:30 p.m. until 5 p.m. Sorry, not 5 p.m. until 7 p.m. This one longer hour. Also business day follow KL business day. Contract month, spot month, the next 3 calendar month, and any February, April, June, August, October, and December falling within the 12 months period beginning with the spot month. So means you start from the spot, continue for the within 12 months. I show you the FGLD. So this is the contract that available for gold. spot month, November. Spot month, and then the next 3 calendar month, December, January, February, and then alternate within the 12 months start from the spot. So any February, April, June. So we start from November, June. So February. So we start for April, June, August, October, and December. March, April, June, August, October. Okay. So actually, basically, you log into your broker website, you actually can check all the contract available. You don't have to remember what contract you can trade. You actually go in and check. You will see. No need to remember. Like for gold, this one. So we already touched the gold futures. So final trading day, last common business day of the spot month in both London and KL. Actually, last business day of the month. So because with this one, they track the London gold fixed price. So if let's say London on the last business trading day of us and London holiday, right? So we use the day before the holiday of London side. Okay. This is just I'll show you already the contract that available for gold. And then this is the gold chart. Because of the pandemic and then money printing, so people turns to gold to hedge their currencies. So that's why you see the gold prices actually went up a lot during this time. Okay, finally, so we talk about the 3 products and then finally reach to step 3 is open a trading account. So you already know the concept and then the product available to trade, the calculation. Then now you need to open an account to trade, right? So where to open? You actually can go to the Bursa website. The link is here. So through the link, this is also by Bursa Derivative. Broker for derivative. These are all registered, licensed under Bursa. So you can check all the broker available, the number, email address, and the address for you to look up, and then you call them saying that you want to open a stock account or you walk in. Okay. And if you know any reminder or broker, then you call them actually faster, or you can look for Shane for LifeChamp to get the contacts also can. So you get the details and call in, okay, or walk in. Usually to open a stock, to open a trading account, document required almost the same. It may differ from broker to broker. So copy of IC, front and back, you cross it, and then latest payslip and then latest bank statement. You need get ready these 3 documents first, and then you have to sign the futures trading account opening forms. So document, IC, payslip, bank statement, and then sign form. Then you submit. Usually within a week or 2, then your account will be open. Then your broker will tell you, or you receive an email saying that your account open. And once open, they will ask you to register online trading account. To open an account, actually to get you a account number, and then you need to register online trading account for you to trade, buy and sell, to track your position and then to check your fund inside. So we need a online trading account. So now in the market, the normal one would be AES, GTS. You will heard about this, AES, QST, platform, and CQG. So this platform may have monthly system fees. So you have to confirm with your broker whether do you have waiver or not. If let's say you trade up to a certain volume, or you still need to pay for the monthly fee. So you have to check with your broker whether got fees or not. Okay, so like take one example. This is from RHB one. So you will see like this is the AES, GTS, AES, and then QST, and then desktop for CQG, all that. So like for AES, mainly for new trader, So if let's say you go and open an account, you can direct tell them I want to use AES GTS. You tell your broker. So this is mostly for new trader, and then high volume trader can go for QST. Professional trader can go for CQG, because CQG sometimes, usually CQG got charges, or they have a higher requirement on volume, because they want more expensive. Okay. Step 4. Once you register online account and activated, you have to fund the account for you in order for you to go in one contract to do trading, to start trading. So double confirm with your broker how to fund the trading account. They will give you a bank account number. So remember, it must be payable to the broker name, like for RHB Investment Bank or Affin Hwang or CMB. If let's say your broker pass you an individual personal account, then you run away. They want scam, okay? Because got many cases happen before, like client, they do not know, then they transfer the money to their broker. They do not know that actually we have to transfer to the bank. Okay. Okay, step 5, trading plan. Before you start any trading, of course, this is very important to set a trading plan for yourself so that you won't get messed up or you feel confused. If there's a market against you and you do not know whether you need to cut loss or anything. So always have your trading plans, your risk management plans, and money management. This you actually can learn from readings or go for classes to improve this. So this is some example, simple way to create your trading plans. So first, outline your motivation objective. What's your motivation to go in to trade futures? What's your objective that you want to do trading? Everyone want to make money also. So maybe that is one of your objectives. So you have to very clear. And then second, you decide how much time you want to commit to trading, because trading is not something that you go for 2-hour classes, then you can be professional. No. There is a saying why that 95% or 90% of the traders fail in the market. Only the 5% make it. Because trading is a professional job, I would say. You wouldn't expect that someone went for 2 hours classes or crash course and then come out they can be a surgeon sudden. So trading is the same. So it is about time and effort that you put in, you committed to do trading, because market always changing. So you have to monitor the market's behavior, and then you have to study like what data or what news will affect the price. So you have to do all this study and research. And then the third one would be define your goals. So like I want to make 100,000 within a year. So you set a goal like for 1 month I will have to make 10,000, and then for 1 week you have to make how many, and then for 1 day you at least need to make how many. So you break into these small goals to be easier for you, rather than you just want to go in and just make 100,000. So it did not work that way. It do not work that way. So next, choose a risk reward ratio. So this is about money management. You can get it from any book outside. So it's like basically it's like you want to risk 50 ringgit, then you at least make 100 ringgit. Means usually people will say the risk that you want to the risk you're willing to take is 1R. Then 1R you have to at least make 2R return. So that one I leave it up to you. Okay. So and then decide how much capital you have for trading. So you have to save enough money, put aside, and the one for trading. You start with, let's say 100,000 for trading. So this is the money for you to do trading. And you do not, if let's say you only have 100,000 for living, you don't put all 100,000 for trading, because trading involves risk. So you lose money, you may lose money, or you lose all. So you have to set aside like maybe 50,000 for me to go on my day-to-day operation, and then the 50K I go for trading. So you have to plan your budget into trading so that it won't affect your daily life. So and then 6, assess your market knowledge. Of course, this one you have to put some effort, go for classes, read some books, and then do more trading or paper tradings to improve that. And 7, start a trading journal. You have to write down your position, and then why you take losses, why you make money. Is it because of luck or strategies or something? You have to take, and always review them and make comments. See whether you improve from last time or not. So see whether your losses making, is it continue very consistent or reduce or improve. So you have to constantly review your journal so that you can improve. So this is basically how to do a trading plan. And step 6, last step is to start trading. So we talk a lot, also no use. We have to start trading, then you will start to know, you will start to learn how to be a trader. Okay, and the end, have a good evening. So I pass back to Shane.
Okay, thank you so much, Fiona, for your very comprehensive, detailed analysis of what actually is futures. I think you started with the concept, what exactly are futures, is contracts, and then how to make money in the bull market and bear market, followed by understanding the different products, and then step by step getting us on how to open an account and how to fund the account and have a trading plan, and finally we're all set for futures trading. So thank you so much for the very comprehensive sharing on getting started in futures trading. So if you all have any questions from Fiona, please write in the control panel and the questions box so that we'll be able to address that. All right, but it may not be that all questions will be able to answer because we have a few hundred of you on the line. So if we can't get your questions, so we apologize first. Okay. All right. So the first question on my panel is, why for FKLI close price and settlement price is the same, while FCPO there's a difference between closing and settlement price? This is by Jason.
Settlement price of the crude palm oil actually, why is it not same?
Yeah, his question is, why FKLI the close price and settlement price the same? FCPO, why is it not same?
Okay, this one I actually didn't really check.
Okay.
This one I will pass the question. Sorry.
Okay, no problem. The next question is, why FGLD has no volume?
I think because of we cannot. I think because people will go for the CME gold, that one.
Okay.
I'm not
So there's a lack of market interest in the futures.
the Malaysia
gold
gold future,
Malaysia
because
for
we
now,
involve conversion also from USD to Malaysia ringgit.
Yeah, but don't worry. Bursa Malaysia derivative is doing their best, okay, to get more trading participants for the, for the other products, okay. So when we do enough education, I guess there will be more demand to buy or sell these futures contracts. All right. So the next question is, do you know if there are other investment banks that offer CQG trading platform besides the RHB? So this is by Sam Yin.
Oh, okay. I know CQG.
If I understand correctly, I think Philip Futures does provide.
Philip Futures. And the other one, what? I couldn't remember the name. Because this one, I think you have to check the list from the Bursa Derivative website, and then you call to ask is better.
Yeah, so okay, no problem. So you don't have much idea lah, okay, but I think you just check with the respective broker to see whether your broker does provide CQG. Even I don't know, because I never use other others futures broker. I mean, I only use one so so you just need to check with the broker. Okay. Okay, now from your experience, how many % of people are able to make money consistently via futures trading over a long term, like 10 years? Is trading futures has a higher success rate than trading stock investing? So that is by King Kun.
Okay, I share a real story. So like for futures trading, our Malaysia, we have the local participant, right? They actually are registered professional trader under Bursa. So for that top 10, they are actually quite very consistent and they are proven making profit from the market. So for most retailer, because most of the people, they think that trading is easy. They just go in, buy and sell. It's like gamble. They didn't do research. They didn't go for classes and improve their skill. So I would say very high chance they cannot consistently make from futures trading. So it is from my experience. For those who actually have the proper money management and then they really put time and effort to trading and committed to trading, those actually can make it. So like many retailers, they come in just want to make quick money or just hearsay that futures can maybe make 100% or 95% per month, then they come in. Those usually they didn't want to put much effort on learning how to do a good trade. So those usually fail. Most retailer that comes in without a proper training or means learning, putting effort into this trading skill, so mostly fail.
Okay. Yeah, so the next question is from Jason Wong. So how do we deal with the gaps in FCPO trading?
The one is for trading skill already. So in here we are not really touch about technical analysis lah.
Okay. The next question is, what is the software that you would recommend for the technical chart?
Most of the broker, they provide their technical chart, but maybe the basic one. If let's say you want advanced one, you can go for Bursa Station. You can subscribe per. They have the codes listed on their website. You can check Google Bursa Station platform. So you can subscribe their website, their software. Bursa Station.
Okay, thank you. The next question from Izad is this: is future trading different from stock trading accounts? That means if you want to trade both, right? Do I need to open 2 trading accounts?
Yeah, basically two different trading account. Mostly client will ask this question. So if you have a stock account, you actually need to open another account for futures trading. It's 2 different accounts.
Okay. The next question is for Danica. If a person short a futures contract, can the same person long the future contract at the same time?
Mean the same person?
Yeah, I mean, can I short and sell at the can I short and long at the same time for the same
that
person?
Means that means you already closed your position. Because you're doing opposite side, you already closed position. Unless you put a note saying that you long at 1,005, then you also short at 1,490. So means when price go up, you close position for the 1,005. When the price go down, then you close the short position of that 1,490. So, but in the net position actually 0 square. But what we do, what another way you can do is that you long one contract. Means let's say for example FKLI, you can long the November month, at the same time you short the December month. So means you actually become a spread trading. So you can do that way rather than you long and short at the same contract.
Okay. The next question is by Pumugan. May I know when the profit settlement credited into our accounts after close, either long or short position for intraday or by holding overnight? Does it work something like T+2?
No. Instant. For futures mark to market, any profit or any losses will be instant. Deduct from your balance or credit back to your balance. Instant one.
Instant, huh? The next question is there a limit on the maximum number of contracts that a person can hold? This is by Jing Kai.
Okay, when you actually open account, the agreement saying that the maximum contract you can hold is 30 maximum, or 50 50 maximum contracts you can hold. So if let's say you are a professional trader, proven with some supporting that you have experience in many years of experience in trading, then you can actually apply from your broker to uplift the limit, meaning you can trade more than 50. So like usually they will constrain at 30 first and then uplift to 50. And then if let's say you really need to trade a lot, then you have to talk with your broker. So to get approval, because this also need to get Bursa approval.
Okay. The next question is, do you know any demo system or account that we can do testing? This is by Adam Lai.
For demo trading for futures, okay, usually broker they provide demo account. So when you open up an account with them, you can ask them to get you a demo ID.
Okay, that's great. If I may add on to this question, is that you can go to Bursa Marketplace and you can open a futures trading plan under, I think, under dashboard or something. After you created your own account, user account with Bursa Marketplace, then you can try out the futures trading plan by longing, shorting the futures contract with a virtual portfolio. So you can also do that, achieve that from Bursa Marketplace. Okay, let me see. The next question is, how about FM70? Is it launching soon?
FM70 can be traded, but today we didn't cover this one.
Okay, yeah. So let me add on to this FM70. SM70 will be a relaunch in December because with a renewed contract specs. With the renewed contract specs, I think if I am informed, if Bursa never changed the date, it should be December 14. December 14, 2020, we will see a renewed contract spec in FM70. And you'll be able to know lah. I think a few days later, we will do, after they launch, we'll do a session on FM70. So stay tuned to know how you can trade FM70 contracts. All right. Okay, let me see. Can I open an account via online platform like online signature and is it allowed, like digitally open account?
Some broker allow. Like CMB, I think they do. CMB they do. I mean they allow for online sign up account. Some broker they actually take this initiative.
Yeah. If I may add on to this answer, I also know of one broker who can facilitate online account opening. That is Philly Futures. Okay. Well, we still have 10 more minutes to go. Now, do you know what are the FKLI constituents weightage? This is by Koget, if I pronounce your name correctly.
Weightage?
For FKLI.
The top 30 stocks, but I don't get that question.
Okay, now let me take the question. Let me take the question. You see, so FKLI actually is a futures contract on KLCI. So that means FKLI tracks the KLCI index. So if you want to know the KLCI index weightage, Mr. Colgate, if I got your name right, you got to go to FTSE to download their semi-annual weightage. Then to see, you can see Public Bank has how many percent, Tenaga how many percent, maybe 100%, and Top Group 100%, Hatta Liga 100%. Of course, right now we cannot have we don't have the number in mind because the number keep changing every half year, right? So you got to go and study about that lah. Okay, you can go to FTSE, because FTSE is an index provider. You can go there and study about that. In November, they are doing a semi-annual review. I guess by December they will announce that the new weightage lah, okay, and I'm guessing that Cosan and Supermax will get into the top 30 as a top 30 constituent stock in the KLCI. So FKLI will track new 30 companies. So that's where you can get the weightage lah. Okay. I think maybe I did not phrase the questions correctly. So wow, some are asked. Okay, the next question is, okay, that's interesting. I'm not sure whether you want to share or not. What is the riskiest trading decisions that you have ever made, and what happened? This by Nazira.
Riskiest. Oh,
trading.
this is about trading. Okay. Because I do spread trading, butterfly trading for palm oil futures. So the because to do spread trading, we very emphasize on money management. So like for the budget, for the accounts the balance you have, the amount, the money you have, that you cannot go more than 50% of your money to hold position. So the riskiest way I did is I think back in 2016 or 2017. So I used 90% of my fund to hold the butterfly position. And the time, because of El Nino, butterfly usually butterfly range is from maybe -20 to 20, or the normal one with 10 to 10, -10 to 10. And I keep average at 10, and then 20, 30, and then market shoot up to 60. So I already holding 90%, using 90% of my fund to hold the particular butterfly, because I'm shorting. And then the next day, Bursa increased the margin. So I straight away need to cut loss. So it's instant losses I have to make unless I add money. So that one is the riskiest trading that I did, that I full swing. I used almost 90% for my fund to hold one direction for one contract for one direction.
Okay, wow, that's interesting. Why Bursa raised the margin on that day?
Because volatility increased already.
Yeah, the El Nino.
I lost about 40%. My money gone.
Okay. Oh, heartbreaking. Okay. Okay, sad things don't want to mention anymore. Okay. Every setback is a stepping stone for our next success. Okay. Yeah, so today you're in luck because you can hear from Fiona, okay, some of her live trading experience, so you know what to avoid. Okay. So the key lesson here is, don't maximize your fund. Okay. Don't maximize
because
your
futures is a leverage tool. Because just how we do a calculation for the table about, I don't remember, about 19 times or 16 times leverage. So for the 90% you holding the position, actually the nominal value actually bigger. So when profit, of course leverage so you profit a lot. So opposite also true. So your losses also multiply very fast.
Okay, then the next question is by Samyin. Is there any artificial intelligence app available to help us make successful trading decisions?
AI.
Yeah.
I don't come across a real AI system yet for now. But this is one area that, if let's say you want to explore, okay, for the AI, because it is still a lot. It's a lot related to programming, and then those data input is a different set of knowledge or skills. So if you actually from this line, I think no harm to try to actually create an AI system. So like for normal people like me, I will just do normal trading.
Okay. All right. So the next question is by AB. Once I start trading, do I need to trade every day, or is it okay that if I do not trade for 1 to 2 days?
Actually, we do not need to trade every day. So there's a saying, it's like this: only fool that think that they need to trade every day. So we trade when because before we go in for trades, we have our trading plan, our strategies, our setup, I would say, when we want to go in or when we want to get out. So until that setup appear, then only we put on a trade. So if let's say normal day, then you don't see any setup that match your setup, then you do not need to jump into the market. So for the normal day, if let's say no opportunities, then you just monitor the market behavior, then you note down the market behavior so that you can read back, and then you have more understanding towards the market pattern. So it's better, actually useful for you in future if let's say you want to be making consistently from the market.
Okay. The next question is from Mr. Cow. It's from Cow. Is that how much do you think a trader need to fund for a startup capital, and how many winning trades do you think a trader need to have so that we can continue trading in the years to come?
How much fund you need to put into startup depends on what contract you want to trade. So at least 3 times of the margin, but like myself, I prefer to put 5 times of the margin required for one lot. So you can use that formula to calculate roughly how much money you have to put in for one contract. If let's say you want to go in for 2 contracts, then you times 2, means 10 times the margin required. So the other question is what?
How many winning trade percentage should we achieve that we can so that we can continue this career?
I would say so long your winning rate is higher than losing rate lah. So 50-50 cannot. So at least higher than your losing rate. We are not actually only calculate the winning rate, we also need to calculate the losing rate one. So the winning rate must be higher than the losing rate. Else, the more you trade, the more you lose.
Okay. Also need to have a favorable risk to reward ratio lah, correct? Like when you win, you get how many points. When you lose only this amount of point to justify lah. Okay. All right. So I guess today we are probably coming to an end. I think there are still quite a number of questions on my screen, but we can't do all questions because there are just too many questions on my screen right now. So let me just take over the control as the presenter to tell you more about our next sessions. So our next webinar is on the topic, the mind game for trading success. Okay, so this is a mastery of the mind, a mastery of a trader psychology when it comes to trading. It will be conducted by David Low. The session is on 3rd of December. That's Thursday, 8:30 to 10 o'clock. So the registration link is here, but I've just sent you the registration link. I'm sure that you don't want to miss out this session because when it comes to trading, the psychology is very important. The emotional state mastery is very important. So that's why you need to join this session, the mind game for trading success. Okay, happening 3rd of December, which is next Thursday. Okay, just give you the registration link and do register if you feel that this session is helpful to you. Now, before we end the session, this is a good news for you, which is we are doing a post-webinar survey to get your feedback. Now, the 6 lucky respondents who answer our survey will walk away with a Touch and Go e-wallet reload pin worth 50 ringgit. Now, the survey will be launched after this webinar and will also be sent to you via email. So lucky winners will be reached out within a week. Now, in other words, if you fill up our survey, which is, of course, we just want to solicit your feedback on where what we have done well and how we can improve. we'll pick 6 respondents every session to walk away with a 50 ringgit reload pin. So just help us with the survey, and you'll stand the chance of winning this 50 ringgit. All right, so not only we give you education for free, we also give you a free cash voucher if you are one of the lucky persons. All right, with that, I want to thank Fiona for coming online with us to share with us very comprehensively about what is futures trading, how we can get started, the 6 steps, okay, by talking about the concept, talking about products, and talking about the journey from funding your account, picking the right broker, to having a trade journal, to finally start trading. So thank you so much for sharing the idea. I guess our audience today also learned a great deal from you. So, and most importantly, I thank everybody for staying for tuning in until the end of these sessions, and we will see you next week, next Thursday, on our mastering the mind for the trading success. Okay, bye bye.
Bye.